Now, here with more analysis of the Fed's action and the president's proposals today, Michael Darda, chief economist with MKM Partners. Michael, always great to see you.
Thanks for having me.
So first, what do you think of this $200 billion excess TARP money going toward job creation as the president's proposing?
Well, I think it's well-intentioned, but at this point, it probably is better for us just to have a little bit of patience. I think this labor market's turning. We're going to have to wait a few months or a few quarters, but nothing we do now in terms of policies is going to have any kind of an immediate influence. A lot of what was proposed today is temporary in nature. It's unlikely that businesses are going to pick up employees based on temporary policies. So I do think it's well-intentioned. I like the idea of capital gains tax cuts, but only aimed at small business and only for a year probably is not going to move the dial. But just to circle back to what I said before, I think we're getting very close to a real inflection point here in the labor market where we actually start to see net job creation. The indicators on the leading edge of the labor market, like first-time jobless claims, temporary help, I'd even throw in the credit markets and corporate earnings, have all turned. So we just have to have some patience. This labor market will be turning in the months ahead.
Where will we see these new jobs?
Where will we see them?
Yes, if you're talking about net positive job gains, where
Sure.
will we see those first jobs come back?
Well, we actually, this past month of November, we actually saw the first increase in private sector service jobs since December of 2007. So services employment is by far the largest share, about 4/5 of U.S. employment. But I actually think we're going to start to see some jobs in construction and even manufacturing in the months ahead.
All right, so now there's this concern. In fact, the Fed chief himself raised concern that there are serious headwinds ahead for the economy into 2010. And we just played the sound, or we just recapped Andy Xi, the former chief Asian economist. Bernanke prescribing poison to the U.S. economy by keeping rates near zero, fueling a wave of speculative capital. So could this derail all of these good things you're describing? What do you think of the Fed's role here?
Well, the Fed is trying to play an actively supportive role in a very difficult position and balancing act here. If the Fed does overstay its welcome and is too aggressive with policies, it certainly sets up the potential for a bubble or inflation down the road. I don't think we're there yet on the asset bubble stuff. There's certainly the potential for that with the Fed sitting here with rates at zero and a lot of liquidity in the system. But the Fed's largely trying to do what it's doing to offset this credit market shock that we've had. They've been successful in that aim, and they're also trying to lean against the wind of the commercial banking sector, which is not making loans. Loan growth is a lagging indicator, however, so we shouldn't write off the recovery because loan growth hasn't come back yet. But as that happens, the Fed will have to start to move in the other direction. So they're going to need to have the infrastructure in place next year to start to reel that liquidity back in. So I would actually say my grade for Bernanke is an incomplete. I think he's done what he's had to do under extremely difficult circumstances. Many members of the Fed, including Bernanke, probably deserve some blame in terms of keeping rates too low for too long in the early 2000s. But at this point, I think you have to take a step back and give him a lot of credit for the past 14 months or so.
And in our remaining seconds here, Michael, you have to work in these emerging market debt concerns, Greece getting a debt downgrade. So how does that factor in to the markets? We're seeing a stronger dollar today and people returning to U.S. Treasuries.
Well, I guess the question is, whether the things that are going on in Dubai, which is sort of an accident waiting to happen here, and then the peripheral effects, if that will really increase systemic risk in a global basis and damage the prospects for global recovery. I think on that score, the answer is no at this point. We're not really seeing those weaknesses in local economies, let's say, radiate out into total global debt spreads or anything like that. So I think this is probably temporary.
Got to leave it there. Michael Darda, MKM Partners.